It's Jobs Week, and join us now to discuss, among other things, Friday's government report, the Fed's fight against inflation. Nick Timiraos, the Wall Street Journal's chief economics correspondent. It's good to see you, Nick. I'll start with something that struck me as interesting last week, and that's when someone made the case that the risks are symmetrical. And they were talking, and I was saying, why is the Fed so dead set on cutting right now, given all the things that we're seeing in the market? And, you know, it just seems like a pretty good time. GDP-wise, consumer spending, all the things we're seeing. They said because you're starting to see the other side of the mandate come into play. Where are we seeing employment show signs of cracking? Are we?
Well, I think the first question you asked there is, why is there this bias or this desire to cut? And I think it's because nobody really thinks a 5.25 to 5.5 nominal Fed funds rate is neutral, right? So the debate is really how far above neutral are we? Is it just a little bit, or is it a little bit more than that? And so I think that's why you've seen Fed Chair Powell and others on the committee certainly at the beginning of the year on their front foot, ready to ease. You just don't want to overstay your welcome at 5.25 when inflation's been coming down. But I do think the Fed is going to be boring for a change. You can take the summer off. The committee is united around doing nothing right now. And yet that doesn't mean everybody feels the same way. There are some people who are uncomfortable with talking about cutting. And there were people earlier this year that were uncomfortable with overstaying their welcome at a 5.25 to 5.5% neutral rate. But I think it's kind of autopilot wait and see right now until the data tells them to do something different, Joe.
I guess it's in the eye of the beholder about whether you really think we're restrictive, because it seems we got like we have a lot of breathing room on the employment side of things. Do we need when the mandate says full employment? Do they mean 3%? They really mean full employment? We've never had an employment number or an unemployment number stay this low for so long, Nick. It seems like we got some breathing room there. Inflation, I have no idea if they're ever getting down to 2%. In a year, in 2 years, I have much less confidence in that than we're starting to see a slowdown in labor. So I don't see why the risks are symmetrical.
Yeah, no, I think you're right. I mean, there's a debate right now. It's the same debate we've been having for the last year. It hasn't been resolved. One side is saying, look, the longer you stay here, the more likely you are to create weakness in the parts of the economy that were just completely unprepared for the rate shock that we had in 22 and 23. That would be commercial real estate. That would be the regional banks. And the longer you do interest rates here, the more that you will tighten the economy passively and something could break. The other side, this is something that Jan Hatzius and David Miracle at Goldman have been on for the last year, is that rate cuts are optional. The economy's fine. You're past the peak impulse from the rate shock. And so businesses have had time to adjust. Households are adjusting. The consumer's doing well. Your last guest made that point very well. And we have a little bit, I think, of a different cycle here, Joe. This hasn't been a credit-driven expansion. This has been wealth and incomes. Asset prices are strong. Consumers feel wealthier. They're spending more. And so until jobs and incomes change, it's hard to see how you have the slowdown that a lot of people have been anticipating. So in your
gut, Nick, and you follow closely in addition to, having access, you're pretty sure that the default move will be a cut. There's no way we're going back to a stop-start. Maybe I'm just, because I was a child of that era, I know how easy it is to think that you've, put a stake in the heart of inflation, and you really haven't. You're convinced that the next move will eventually be down.
No, never say never, but I think you have to ask yourself, where is the reacceleration going to come from? It could come from wages, but we see wage growth slowing down. It could come from
OPEC.
Yeah, it could come from a shock. Certainly, I think a shock is the most realistic way you get this. But look at oil right now. It's not threatening, $100 or something that we were talking about last fall. You could have inflation expectations move up. That would get committee members' attention at the Fed. Or you could have a global growth reacceleration. But I think all the things you'd need to see to put hikes back on the table, they're not really barking at you right now.
Right. Well, then it was a successful soft landing, and that's all we needed, and we're back at cutting, and the market's going to love it, and what a world. I just, nothing else is going right in the world. Maybe this will be a real happy ending, so to speak.
Yeah, I think the path for a soft landing has narrowed some because the inflation that we saw in the first quarter made the Fed reluctant to do the soft landing mid-cycle adjustment. It means there's a greater risk that they're going to wait to see something break in the labor market before they start cutting. And so they have, I think, trauma. There's a little bit of PTSD from not just the inflation surprise of 2021, but then the second half of last year where they thought they were going to need to really slow down the economy to get the kind of disinflation we saw. Right. And instead we got the disinflation with strong consumption growth. So when the Fed or when central banks just aren't confident in their ability to forecast inflation, and look what happened in the UK. The Bank of England was ready to cut, and then they got a bad services inflation number. Right. The ECB is going to cut this week, but they got a services inflation number last week. So there's a little bit of PTSD here, which just makes them more data dependent, more reactive to the high frequency numbers because they don't have confidence in the forecast.